Once I understood that better, I think it made me a better investor, I think.
Warren Buffett's right-hand man, Charlie Munger, sat down this week with CNBC to discuss his advice for investing in 2023 and revealed some of the secrets to his multi-billion-dollar wealth. The 99-year-old is the vice chairman of Berkshire Hathaway, arguably the greatest holding company of all time, generating a 3.6 million % return for investors over 57 years. A $1,000 investment in Berkshire in 1964 would be worth about $35 million today. For comparison, $1,000 in a simple S&P 500 index would be worth about $300,000, less than 1% of the performance of Warren Buffett and Charlie Munger. During the 2.5-hour Q&A session, Munger gave us some advice that directly applies to the investing challenges that we face in 2023, which of course include the raging inflation and persistently rising interest rates. After watching and note-taking the entire session, I hand-selected a few clips that I'm going to show you today, as they contain a ton of value for someone looking to improve their financial situation. The investing environment we face in 2023 is very different to that of the last decade and continues to evolve day by day. The biggest challenges are, of course, the persistently high inflation environment and the subsequent higher interest rates that are needed to prevent it spiraling out of control.
Well, there's no question about the fact that as interest rates have gone up, it's hostile to stock prices. But they should go up. We couldn't have kept them forever at zero. And I just think it's just one more damn thing to adapt to.
It cannot be understated how abnormal the 0% interest rate environment of the past decade really was. 0% interest rates meant that safe places to put your money, such as government bonds or savings accounts, offered no return, pushing people to take more risk to earn the same returns that they could achieve basically risk-free in the decade before. 0% interest rates meant that borrowing money was extremely cheap, driving up household, business, and government debt. And maybe most importantly for the stock market, 0% interest rates meant that business models that normally wouldn't be sustainable were able to survive for many years and appear like viable businesses. Today, major countries around the world face the worst inflation in decades, and as is the cyclical nature of economics, we find ourselves heading away from rock bottom interest rates and back to a more normal credit environment.
There are headwinds and there are tailwinds, and one of the headwinds is inflation. And I think more inflation over the next 100 years is inevitable, given the nature of democratic politics.
We've seen our fair share of supply-side inflation recently, where bottlenecks or geopolitics have sharply reduced supply, which has increased inflation. But Charlie is talking about demand-side inflation, which can in part be driven by reckless government policies. The public, people like you or me, banks, funds, and other governments all participate in buying government debt to support their excess spending that isn't paid for by tax revenue. But if there's a lack of buyers for the debt because government spending is far exceeding the demand for the debt, then the Federal Reserve needs to step in and print new money and buy those bonds, which in effect means that the US government for very long periods of time doesn't have to ever run a surplus to make up for its previous deficits, increasing overall demand and driving persistent inflation.
That's one of the reasons the Daily Journal owns securities instead of government bonds. Owns common stocks instead of government bonds.
But as the end of his answer to this problem suggests, the solution is to own businesses instead of government bonds. And Munger, of course, doesn't mean be a full-time trader looking at charts and trying to exploit tiny price movements as stocks fluctuate on a day-by-day basis. He's talking about storing a portion of your wealth in a few high-quality businesses and letting those businesses do the work for you.
As long as Costco keeps the faith with its strong culture and their extreme low markup policy, I don't see any stopping it.
Costco is one of the few businesses that Munger owns personally outside of Berkshire Hathaway. He has almost $100 million personally invested in the company, of which he's been a director since 1997.
And it has a marvelous future. And it has a wonderful culture, and it's been run by wonderful people. And I love everything about Costco. I'm a total addict, and I'm never going to sell a share.
What makes Costco a great business is its deep economic moat and a management team that strives to uphold that moat no matter what. Costco could be a far more profitable business if it marked up its products at a similar rate to Walmart and its other major competitors. But by choosing to sacrifice profit today, they've essentially built this powerful reputation for having the lowest prices, and that's been reciprocated by customers ordering in higher volume over time. And by applying this culture as they expand into new new markets, they're likely to deliver high returns on their invested capital. But it's not just enough to invest your money in high quality businesses, because after all, investing is a game of outlaying money today to get more back in the future. And if you think of a business's future profits as this fixed, finite figure that we can't influence, then the way we can influence how we perform on an investment is by carefully considering the price we pay for that business.
The trouble with Costco is it's 40 times earnings, but except for that, it's a perfect damn company.
Costco is an incredible business that will likely be thriving for many years to come, but the price of entry to own a piece of the business has become too high for the investment to make sense.
I regard Alibaba as one of the worst mistakes I ever made. In thinking about Alibaba, I got charmed with the idea of their position on the Chinese internet. I didn't stop to realize they're still a goddamn retailer. I got a little out of focus, and that made me overestimate the future returns from Alibaba.
Munger, during the Q&A session, described how he made this exact mistake with his investment in Alibaba, the Chinese online retailer which has been one of the most popular stocks among value investors of the last few years. Munger initially invested into Alibaba in Q1 of 2021 at an average price of between $220 and $260 per share. And while he was able to reduce his cost basis by making further investments at lower prices, his initial investment went on to fall by almost 80% in 2 years. In hindsight, Munger believes that he overestimated the future cash flows of Alibaba and was therefore willing to pay more for the stock than he should have, given what he knows about the business today. On the other hand, if you don't overpay for a business, then you really don't need to worry about the daily or monthly price fluctuations of the stock at all. Take Thor Industries, for example, a stock that I've held for 5 years. I've watched it go from 130 to 40 to 150, back down to 70, and then back up to 100 recently. But while the stock chart fluctuates wildly, the intrinsic value of the business does not. So every time its price falls below the value, I buy more, and when it's above the value, I just hold the stock. And over the long term, that's meant that I've been able to generate a pretty nice double-digit compounded return out of the business.
The good businesses don't stay cheap. You got to somehow recognize a good business before it's recognizable as a good business. That's very hard to do.
The fundamental idea is to find the infrequent times that a really good business is selling relatively cheap. That way, if the business doesn't perform as you expect, the price you paid ensures you'll still make a reasonable return.
You will find, by and large in America, if it's really a great business, it's at least 25 times earnings and maybe 30 or 35 or something. So that makes it much harder, of course, because if something goes wrong, you can lose a lot of your investment.
Here, Munger is talking about what happens when you pay a premium for a high-quality business. Potentially, the business does meet the high expectations that you had when you bought the stock, and you still do reasonably well. But if you do this, then you're also exposing yourself to the reasonable chance that the business underperforms your expectations, and you lose a ton of money. And I honestly think Tesla is a really good example of this. 5 years ago, the stock had extremely high expectations for a business that wasn't profitable and carried a significant bankruptcy risk. In hindsight, of course, Tesla went on to perform extremely well and meet those very high expectations that the market had, and it's been a great investment over the past 5 years. But it could have easily gone the other way, with investors losing absolutely everything. So it's really important to think about what happens if the business doesn't meet these massive expectations of 20, 30, 40% per year growth. What happens if they don't grow? Will I be completely wiped out, or is the price that I'm paying for the stock allowing some kind of margin of safety for me to still do okay if things don't pan out as I expect? In the interview, Munger explained a few of his mental models that play an important role in your investing decisions over the next decade.
What is the appropriate percentage of your net worth you should put it in a stock if you think it's an absolute cinch? Well, if you're the kind of fellow who's right and when you think something is a cinch, the answer is 100%. Or maybe 150%. I had to name one factor that dominates human bad decisions. It would be what I call denial. If the truth is unpleasant enough